So if you're normally doing 10, 15, 20 contracts, bro, go 7, go 6. Right, that way you still partaking in the market, but you're not overbought on the market. You're not over leveraged on the market, right? You're because you understand that. Here's what you don't want to be. You don't want to be so over leveraged in the market and you see that the volume is not there. If you don't know who this is, Larry Fink is the CEO of BlackRock, which is the biggest asset fund in the game. That's where all your iShares, ETFs, that's where they come from. This dude is the real deal. And I want you to listen to something he said, and it was something we talked about earlier too. Like, if you look at a lot of your candles, we talked about that, like you don't see a lot of just like real bullishness in the market, you know what I'm saying? Which means a lot of institutions really just sitting on the sideline. And so I said that to say, he said something, there's $11 trillion in cash sitting on the side. If you're looking at your candles, you notice like, you looking at your charts, like you see periodically, you see those big institutions coming on certain days, but not really and truly, like you really just see low, that's it. Boy, you took the words out. You see low volume in the market right now. You don't see a lot of volume across the market. Why? Because the market really don't have certainty. A lot of the stuff that's being moved around right now in the market is just based on the tariffs, right? And that's what's moving the market right now. The yes or no, that's why even the downgrade ain't really moved the market, because they're like, all right, bet, like you see a lot of stuff going on in the market. It's not really moving the market like it should, because people just on the side like, I'm good, you know what I'm saying? And so you gotta see those $11 trillion. And here's the crazy part about it, right? Look at what he said, and I'm really hone in on this one. He said there's $12 trillion on the side in Europe and $11 trillion on the side in America. Here's the thing, 60% of the money on the side that's in Europe actually wants to be in the American markets.
I think you're gonna have some of the, well, in Europe, there's $12 trillion of money sitting in bank accounts in Europe. In the United States, there's $11 trillion sitting in money market funds. When there is that uncertainty, you're going to keep more and more money in cash, and that's what we've witnessed. In addition, because of the uncertainty and maybe an over-optimism about the United States, we've seen modest reallocation out of the United States into other economies, especially Europe. Yes, we're going to have volatility in the next 90 days, but the big thing that I'll be watching, are we going to be able to see in every economy the opportunity for more active private investments? What I'm afraid of, we've relied too much here in the kingdom and in the United States, too much public investments. The vitality of any economy is based on private investing in the long run. That's what we all should be watching.
Out of that $11 trillion, 60% of that wants to be in American markets. When the markets went down so bad, it was because people were getting, that's where, watch this, the sell, you hear them talking about the buy America trade or the sell America trade. Well, a lot of those countries were taking money out of American markets, sitting on the side. Because American markets was where they were getting the, listen, I'm gonna just be real with y'all. The American market is where you get the greatest return on your money at. That's why so many people love the American stock market. It's where you get the greatest return on your money at. And so countries, Asia, Europe, everybody invest in, so it's not just big institutions, we talking countries, we talking big investors, we talking Chinese funds, we talking European funds, but we do it too though. We go invest in the Japanese market, we invest in the European market, like we do that, right? But the American markets are the most profitable and it's where you get the most bang for your buck. You feel me? And so when you see that $11 trillion of money sitting on the side, $12 trillion of money sitting on the side in Europe, guess what? That was a lot of, at least 66 trillion of that came from out of our markets. and they waiting to get back in. And so that 12, 11 trillion of our money that's sitting in money market accounts, it wants to get back in the market, but because they don't have no certainty. And then you get Scott Bessent, you know, and Scott usually talk good talk. He said, hey, bro, if we don't see these people negotiating with us in good faith, now what happened to all the deals they say we had? They said, hey, if y'all don't invest with us, if y'all don't negotiate us with good faith, then guess what? We're going back to April 2nd. So that's why people are like, that's what I mean by there's no certainty in the market, because there's a chance that we might go back there. You know what I'm saying? And so, and then you had a headline that came out. I thought this headline was gonna kind of move the market this week when it said, China said, hey, America is undermining trade talks with us, when they came out with the Huawei warning. I said, oh my God, the market disregarded it. You know what I'm saying? So there's money on the side that's waiting to get back in the market. And that's why I'm saying for us, it ain't time for us to be all in. Trade with caution. Which brings us to this one right here, right? The institutions aren't coming out to play. Watch this. A net 30 of institutional investors, which is your big banks and stuff like that, are underweight U.S. equities in early May. What that mean by underweight? So when something is underweight, it means they have a lot of money sitting on the side, right? So if something is overweight, they mean so you're gonna go overweight, underweight, and neutral. So those are the three things they're gonna go. Overweight means they heavily invested. Underweight means, we don't got a lot in there, but we got something in. It's like, think about it like a pool, right? If they underweight, they just got their feet in the water. If they overweight, they in the deep end. If they neutral, they sitting on the side with the you just sit on the side of the pool, you be like, yeah, I'm all good, you hear me? Ain't no big deal, dog. You know what I'm saying? So think about it like that, right? So a net 38% of institutional investors were underweight U.S. equities in early May, the lowest since May 2023, outside of 2023. This marks the lowest allocation since the lead up to 2008. Over the last 5 months, the percentage has fallen by 70%, the biggest drop on record. The difference between overweight Eurozone versus U.S. equities is a net 75, the highest since October 2017. By comparison, 4 months ago, the net percentage was 62 points, the lowest in 2022. And what does that simply mean is more people are either on the sideline or investing in the European market than they're investing in our market. And because the European Central Bank has been cutting rates. Again, you gotta remember, the sort of retailers, we can get money in the market, but the institutions move the market. So we wanna have some exposure, but not be all in so we don't get wiped out. You know what I'm saying? What you about to say, Sean?
I was gonna say, for all the trappers that's sitting on the side, what are they waiting for in order to know, like, what's that trigger? What are they looking for?
So so think about it like this. So institutions can't get in all at once. It's too much money. So if you're a trapper on the side, I would say, like, you want to trade in your portfolio with, like I said, optimistic caution. Meaning, like, if you would normally be heavy bullish, it's like pull some of that back, right? Go 50, 60% instead of going 100%. So if you're normally doing 10, 15, 20 contracts, bro, go 7, go 6, right? That way you still partaking in the market, but you're not overbought on the market. You're not over leveraged on the market, right? Because you understand that, here's what you don't want to be. You don't want to be so over leveraged in the market and you see that the volume is not there. Because now what you're doing is you setting yourself up for failure. Well, what you can say is, hey, I see what's going on right here. If I'm only getting, like, even for me, like, I know I'm getting, you know, bro, like last year, bro, we was doing 200, 300. That NVIDIA play that I made, 1.2 million, bro, I had 450 contracts. You feel me? So now I'm doing 40, 50. You know what I'm saying? I did that one NVIDIA play because we got it so low. You know what I'm saying? But I'm like, hey, like, I don't mind doing that. So I'm really going in the market right now with, like, 65, 70%. Like, I ain't really just all out bullish on it. Like, now certain companies I'm heavier, like Spotify, Netflix. I know how they just been running, but I'm optimistic with caution because I'm a bull, but I still also understand nothing has changed. We got one deal that really wasn't that big of a deal, and it was like, nah, we did hear something say, we did hear Scott Besson say, hey, I think we're gonna have some more deals this week, but at the end of the day, everybody waiting for one deal, China. Now, the dope part about that is 90-day suspension, 90-day pause, they got time to talk about it. Cool. What we can do is say, hey, we got a 90-day window to accumulate. I look at us as being in a accumulate. Hey, let's just get some back. You know what I'm saying? We ain't gotta go crazy. Let's just get some back. Let's make the best of this opportunity. So whatever way it goes, we know we can, hey, here we go. Hey, we can go here, but we watching the game move how it go. On the flip side, retail investors have bought a net $4.1 billion in U.S. stocks on Monday between 9:30 and 12:30. The biggest buy on record. This surpasses the previous high of over $1 billion. Retails also broke the $4 billion buy-in threshold by 12 o'clock for the first time in history. Additionally, retail accounted for a record 36% of all trading volume yesterday, exceeding the previous record in the late May. This supported the S&P 500's rapid recovery from 1.1% decline at the beginning of Monday's session into positive territory by close. Retail investors are driving the market. Now, here's what I want us to understand. Think about this. If institutions are sitting on the side and we are the ones piled in, we gotta be ready for whatever trigger they pull. We have adapted the buy the dip mentality. Buy the dip, buy the dip, buy the dip. So what we keep doing is, and I'm gonna say this in a good way. They are professional armed robbers. This be legal armed robbery. They doing it with no ski mask. There's no ski mask involved. There's no ski mask involved. And so I'm not telling us to be cautious at all because, and this is why all my traders know this, like if you looking, you don't see a lot of volume. The reason why you don't see a lot of volume is even though the retailers are pushing the market, we can't push with volume.